The next problem given is related to Mr. Anand. So observing the income information given here is, they are given the profit and loss account of the assessee. The statement, just by observing the statement, but at the end they are given the net profit rundown. And here debit and credit side information is there. For the information appearing on the debit side, they are the expenses deducted by the assessee according to the accounting information, not according to the IT information, IT rules. And credit side, they are given the incomes. They are the incomes according to the accounting procedure, not according to the income tax procedure. Therefore, what the incomes and expenses recorded in the profit and loss account of the assessee, they are according to the accounting rules. The income assessed under according to accounting rules has to be converted into income as per income tax rules. So therefore, first of all, as and when this kind of information is given, before the computation of gross total income, first of all, we have to compute the taxable income from business or profession. Okay, so therefore, first of all, as a step number one, in this case, first of all, we have to calculate the taxable income from business. Okay, so taxable income from business will be calculated under commercial method here. That is, out to the given net profit, disallowed expenses, any expenses which are shown on the debit side, but not related to the business are to be added back. So expenses which are not related to the business, which needs to be added back to the net profit, are called as disallowed expenses. Along with the adding of disallowed expenses, if there are any other incomes given in the additional information, but not recorded on the credit side of the P&L account, called unrecorded incomes. So therefore, any incomes are taxable under the business, but not credited in the P&L account, they have to be added. So to the net profit, first of all, we have to add disallowed expenses and incomes are taxable under business. Incomes taxable under business, but not credited in the P&L. So taking that one as a first step in the computation of business income, here net profit given as per the P&L account is 1,12,000 rupees. To this one, we have to add disallowed expenses and incomes taxable under business, but not credited in the P&L account. So expenses debited in the P&L account, not related to the business, or in other words, which are disallowed as per the Income Tax Act, are one is proprietor salary 60,000, drawings 20,000, both are one as personal, interest on capital also one as direct, that is rupees 40,000, reserve for VAT, any reserves, even the reserves and taxes are also not allowed, provided the reserves kept for taxes but not paid before the date of submission of ID returns are also be disallowed. Therefore, here reserve for VAT is disallowed 20,000, and transfer to any reserves and surpluses are also disallowed 80,000. Therefore, total disallowed expenses are rupees 2,20,000. There are no any incomes given in the adjustments which are related to the business. Therefore, the next step in the computation of business income is less incomes are credited in the P&L account. There are some incomes which are credited in the P&L account, but those credited incomes are not related to the business, means they are chargeable under another heads of income. So here gross profit business, rent received, income from house property, dividend from Indian company, taxable under then income from other sources, share of profit from HUF also taxable under that income from other sources. Therefore, here the rent received, dividend from Indian company, share of profit from HUF, they are not the incomes earned under the head of business which are taxable under the other heads. Therefore, both 75,000 of rent received, 40,000 of dividends, and 60,000 of share of income from HUF are to be deducted. So taking that one as here. So here less, that is income taxable under other heads. The one is rent received 75,000, dividend from Indian company 40,000, share of profit from HUF 60,000. Total amount of incomes which are taxable under the other head but included in the net profit of the P&L account is rupees 1,75,000. So therefore, here net profit as per P&L account 1,12,000 plus disallowed expenses 2,20,000 minus deductible amount 1,75,000. The remaining taxable income of business is 1,57,000. So after the computation of income from business, the second step, likely in this type of questions, the next step is computation of the taxable income, that is gross total income and taxable income. So first of all, as usual, we have to calculate the gross total income. Here, gross total income, salary income is nil, income from house property, rent received 75,000, municipal tax paid given the penal account debit side 5,000. Therefore, the balance is 70,000. So annual value 70,000 is there. Then standard deduction rate of 30% goes to 21,000 is to be deducted here. Then the balance of income is rupees 49,000. That is the income from HP. Then income from business and profession computed given 57,000. Capital gains not given, it is nil. Then income from other sources, that is interest on bank deposit 6,000. Then dividend from Indian company exempted. Share of income from HF is also exempted. Therefore, taxable income from other sources is 6,000. So therefore, gross total income is rupees 6,000 here. Total gross total income. Income from other sources is 6,000 and gross total income commencing from salary nil to the income from other sources of 6,000. It is 2,12,000 rupees only. Here also, the total income, gross total income is 2,12,000. Next, deductions. Investment in NSC, ATC, 10,000 is available. Donation to notified temple, 80,000 available under ATG, 5,000 rupees. Interest from bank deposit, 88A, maximum 6,000. That is actual interest, maximum 6,000. Maximum 10,000, 6,000. So therefore, total deductions available under section ATC to ATE. ATC 10,000, G 5,000, TTA 6,000, totally 21,000. So therefore, gross total income is 2,12,000. Deductions available under section 80, 21,000. Therefore, taxable income is rupees 1,91,000. Okay. So on this 1,91,000, you have to calculate the amount of tax payable by the assessee. So here the assessee is given, but his age is not given. Therefore, you have to assume that he is the individual not exceeding the age of 60 years, means non-junior, non-senior. Being the non-senior, up to 2,50,000, he need not to pay tax. Means it is an exempted or ceiling limit. So therefore, the taxable income is 1,91,000, less than the ceiling limit. Therefore, his tax liability in this case is nil. Okay, dear students, this is the way of computation of gross total income, taxable income or total income, and then tax liability of the assessee. It includes step number 1, calculation of gross total income, step number 2, calculation of total taxable income, and then step number 3, computation of the tax liability. Okay, so likely you have to make a practice of the problems given on this one. For this,